Now, this wasn't the cheapest refurbishment we ever did, and it certainly wasn't the biggest, but it's the one that changed everything about how we approach HMO projects from here on out. And here's why. Can one property really bring in £63,000 a year? Well, this one does, and this project became a real turning point for us as investors and as a business. And in this video, I'm going to walk you through that full story, what we bought the property for, what we changed on the property, what it costs, what it earns now, and the 5 biggest lessons that we took from it that changed the way that we approach every single deal that we've done after this one. Now, if you've seen a number like £63,000 a year before and thought, is that net or gross? Or surely that must have been expensive, so what did it cost? Or thought, how did you handle for voids and risks and things like that? Or is this actually a repeatable process, or is it just some fluke one-off that won't work today? Well, don't worry, because that's exactly what I'm going to answer. My name's Stuart French. I've been in property for over a decade, and I run a HMO lettings agency and investment company in Kent with my business partner, Greg Railton. We've brought around 100 rooms to market now, with more in the pipeline for 2025 and beyond. We've been nominated for 4 industry awards as well. First, I'll give you a quick walk through the property, show you around. This one's a 7-bed, all ensuite, and I'll show you what we changed, what we nearly got wrong, what we definitely wouldn't do again, and how we applied the lessons from the last projects that we did. Then I'll walk you through the 5 biggest things that we took forward into the next project, all of the stuff that will actually help you avoid wasted spend, bad layout choices, and ultimately get your shot closer to the bullseye to make more money long term with HMO investing. And at the end of the video, I'll open up the spreadsheet, show you everything: the purchase price, refurb costs, valuations, refinance figures, the monthly cash flow, and how it set us up to fund the next projects. And if you want all of the numbers in writing to look through yourself, the full case study is linked below in our free community, along with 3 others that you can download and use as guides on your next deals. Let's get into it. So here's the property. It's in a really good area, central area of Maidstone. It was bought as a 3-bedroom property with this awesome double chamber basement on the back, on the basement level. So 1, 2, 3 bedrooms on the first floor, plus you've got this is the existing lounge, stairs going up, basement level, which we'll go down to in a second, dining room, and kitchen to the rear. Now, what was super interesting about this property and why it grabbed attention was this awesome double chamber basement down here, completely underutilized, full front to rear double chamber basement, and I'll be showing you in a minute what we did with that. Upstairs, large bedroom to the front. Got a loft which we'll go up into in a second, and then you've got middle bedroom here, which is a good size, and then this rear bedroom, so bathroom there, and this like tiny little kind of box bedroom at the rear, which is always kind of tricky to kind of figure out what to do with that, and this caused just a lot of headaches. So I'm looking forward to showing you what we did with it. Now, the big question at the start of this whole process was, what do you do with this property? Do you do a 7-bed? Do you do an 8-bed with slightly smaller rooms? You've got some problems to solve here. And we've got this huge loft. Let me show you inside this loft here. Very tall ridge height here, which is what you want to see when you look into a loft. This is our property on the left-hand side, and then this is the neighbour's property. So some problems to solve there, but lots and lots of space. Now, the initial problem was to reinstate this firewall here. So if there's a fire on either side of the property, then it's not going to leak through. So you need to reinstate this. It's a pretty decent tip, actually, if you're buying property in general. You've got for insurance purposes, your you have to have a fire break between the lofts, and some of them have gaps and stuff at the top. So just make sure when you've poked your head up into the loft that you don't have this situation essentially. But incredible loft space up here, very high ridge height, which leaves it open for an awesome rear dormer extension, which is ultimately what we ended up doing. So let me show you the finished article. So what did we eventually do to this property? We turned it into a 7-bedroom property, all en suite for 8 people. Now, we ummed and ahed for a long time over whether it should be a 8-bedroom property, what to do in the rear, but ultimately we made some decisions to turn that into a 7-bedroom rather than an 8-bedroom. And I'll walk you through more of what we did. Let's have a go. Let's start from the front. So this is us coming in the front door, bedroom 1. We wanted to make the design of this really unique. So in the last property that I showed you, we started down this pathway of kind of making a bit of a unique statement in the market with regards to design. Here's the kitchen, very nice. Lots of space for the tenants, which is great. Very well pointed, and we wanted to make something that was a lot different. Now this is the basement conversion. Managed to get 2 bedrooms down here. Again, both en suite. Nicely appointed. And I'll show you the other one too. Sorry if I'm moving around too fast. This is bedroom 3 down here. And this is kind of like a wardrobe space. Light well here with the fire escape out to the front. But let me show you what we did. So this is the first floor. You can see we tried to make all of the rooms different. All of them have their own features, really nice tiles. And we really wanted to make these pop in the marketing. So when we've got adverts running, we can really make these stand out because there's a lot of similar type properties on the market. Now this is the couple's room. This was the part of the house that caused us the most headache, because we could have done this as a 8-bedroom property and kind of converted this area of the house that we're in now on the first floor. Could have converted that into 2 bedrooms, but you'll see it's just it would have been so tight, and rather than going down the pathway of having smaller rooms, we thought if we have couples rooms instead, then you can kind of turn a weakness into a strength, and you can have all of this space for a couple, and this is going to rent all day long, and it does. Coming up the stairs, this is bedroom on the 2nd floor. Now this is the only off suite that we have. So it's got the bedroom here, which is still nice size. And the bathroom for this bedroom is here at the front. Really nice. It's a good way to use the eaves of the house is for bathrooms, but with the layout of the property, how it was existing, that was a lot of complexity as well, but I think we've managed to solve that quite well. And the final one, the final bathroom here. Now if I go back to this view, you can see what we've done. So converted the double chamber basement, bedroom 1, kitchen diner at the rear, then 2 bedrooms including the couple's room on the 1st floor, and then the brand new loft extension on the 2nd floor. So lesson 1 that I learned on this project is that commercial revaluations are where the real money gets made, but only if you design for them from day 1, which we can. So if I just dip into our spreadsheet real quick, just to kind of demonstrate that, the way in which a commercial valuation works, it kind of works like a triangle. There's 3 things that are the most important. The first one is the rental income. So this rental income figure here. And then the next one is the surveyor cost deduction. So the amount of deduction that the surveyor is gonna make on the gross rent as costs. So in this case, we're using 25% because that's what we got. And then the last one is the area yield. So in order to get a correct market value, and in order to get a correct commercial valuation, you're kind of playing with that triangle: the rental income, the deduction that the surveyor is going to make, and the area's yield. So if you were to say add on another bedroom here, bring this up to 72,000, so we've just added another room at 700, then our commercial valuation goes up. But what also increases is the risk. So if we were going to do that to this property, then rather than having our couples room, say if this was only going to be another 700 again, because you've got, say, 2 small rooms, you still will get a higher commercial valuation, but there's a much higher risk to a strategy like this, because these 2 rooms, those smaller rooms that we made are more likely to have voids because they're less desirable. So what we did instead is increased our room rate to 950 on the couples room and had 1 less room. The commercial valuation was lower, but over time we have experienced that having less people in the house with better amenities means that you have less voids. So over time, that's going to put way more money in your pocket than trying to overdevelop the property. The key things here are to try to find the area yield and the cost deduction that the surveyor is going to make. So just by calling them, you can ask them what their process is. You can ask them what the HMOs that they've recently valued, what the yield that they applied, what kind of costs that they deducted, whether they deducted the actual running costs or whether they used a bulk deduction here based on the gross. And you can implement that into your spreadsheet, or if you're using my spreadsheet from the Kent HMO Alliance, which is this one, is in there totally for free, you can just input the values that they give you. It might be 30%, it might be 20%, all of it makes a huge difference on the actual commercial valuation that you end up with. But based on knowing roughly what your room rates are going to be based on your design, then you can start to project quite accurately what your final valuation is going to be. And this is how you can start to reverse engineer from even before you've offered on the property what the commercial valuation is going to be, and then from that point start to work out how much your build cost is going to be, or you can almost set a build cost based on this commercial valuation if you've got a particular return on investment that you want to hit. Lesson 2 that I learned from this project is that adding extra rooms isn't just a way to increase your cash flow, it's actually a profit engineering exercise too. Now, what do I mean by that? It's more profitable to build than not build. But consider this: if I just remove these numbers from this spreadsheet here, imagine you're going to do a loft extension, and that loft extension is going to allow you to build or add 3 more bedrooms to your property at £750 each. Okay, that's going to add a commercial value of £267,000, say £250,000. And then by the time you're at 75% loan to value, you're going to get 75% of that. So call it £180,000 or something. But your loft extension here, even though in this case it was for 2 bedrooms, even if it was £60,000, you're still making a profit on the building work. So if it's going to cost you £60,000 to add £180,000 worth of value, your delta there is £120,000 worth of additional equity that you can leverage, or in this case £200,000 worth of additional equity that you can leverage at 75%. So it actually becomes a profit engineering exercise to add more bedrooms, because the building work costs less than the additional equity that it gives you, which is awesome. Lesson 3 that I learned from this project is that everyone is obsessed with off-market deals, and my unpopular view on this is that with large HMOs, it actually doesn't need to be. Now, we've sourced more than 100 single lets over the years, and in that market, being direct to vendor or off-market does make a big difference because the property price is cheaper. And with single let margins being so tight, everything becomes a cost-saving exercise. And that's why the term landlord special exists. And to a point, I'll agree that it does matter with HMOs too, because purchase price is a big factor in that. But with large HMO, we're solving for a high end value so that we can recycle our money back out and keep buying more properties. And so it's the quality of the deal that's much more important than just the purchase price, as all of the uplift happens on the back end. Projects do take time to deliver, and at the end, it's got to be worth it. So I'd rather pay a bit more for a 9-bed opportunity than get a few extra £1,000 off of a 6-bed opportunity. Lesson 4 that I learned on this project is that overdeveloping for higher room counts cost me more in the long run, and it's how we actually de-risk our projects by building to what tenants want, not just what looks good or what looks most profitable on our spreadsheet. It's 2025. The tenants that we look for, they already have good jobs, they earn good money, they just can't justify the expense of that 1-bedroom flat, but they still want a great place to live so that they can move out of their parents' house, or they can take a job in a different area, and they can do that nice and easily. So what they want is a HMO, and that's the issue that you're solving in the marketplace as a HMO investor, or at least what my take is on the problem that you're solving there. And what we do to solve that is make well-appointed, really nice properties with good amenities so that those tenants have a good experience living there and stay longer, so that this opportunity for them is a much more attractive one than spending more money on a 1-bedroom flat. So of course we could have had a situation where we had one room here at the back and one room here at the back with like with adjoining corridor, but it's like super inefficient for a property like this. Instead, we figured if we can turn this whole thing into a couple's room, then you'll get a little bit lower, well, a chunk lower per month cash flow, but this room will stay occupied for a lot longer throughout the year. And couples rooms in this part of Kent, honestly, as soon as you post that you have a couples room available, the amount of inquiries that you get is kind of ridiculous. So in order to de-risk your investment, a really good way to do that is just build to what the property has and just do not try to overdevelop it. If you overdevelop it, then it looks really great on paper. You look at your spreadsheet and think, okay, this is awesome, I'm going to get X amount, and the revaluation is going to be much higher. But when you start to run that property, you can run into some problems with voids, which isn't what you want if you've got high interest on your mortgage, which we have in 2025. Lesson 5 that I learned on this project is that unique design is great, but pretty bad when you're scaling, and systems beat style every single time. And that was a huge lesson for me. What do I mean by that? So if I just come in here and we'll just take a slow tour of this property. We've got very unique furniture. We've got all this boarding here, which costs us a lot of money. Everything's kind of designed uniquely, and you're probably seeing where we're going with this. We try to make every single room a little bit different, or at least not so much of a, or at least have like a difference between rooms. We've got the corridors are pretty much the same, but in all of the rooms we've got these kind of features everywhere, different color paints, different colored tiles. The hardware is all pretty consistent, so like radiators and stuff, but when we have repairs on this property, things just aren't as systematized. So if you've got a tenant that's lived in a property for a couple of years and they move out and it's time to redecorate, what do you do? Do you put it back to something neutral? You've got to figure out what that paint color was again. We've stored everything in a spreadsheet so we know which one's which, but when you go and get your paint mixed, sometimes the paint color isn't exactly the same. And if you're just trying to touch up a wall and the paint comes out a little different color because you've gone to Johnston's or something to get it mixed, then you're kind of causing tons and tons of problems for yourself. And we realized that that's just not a good way to scale. So what we did is we went to our designer and we got them to put together a big pack of materials and colors and fixtures, fittings, furniture, all of that kind of stuff for us to use in future projects that looks really nice and gives a high-end finish, but has a lot more sustainability to it in terms of the system that you're building. So that was a huge lesson for me to learn on this project, is that you can make something look really, really nice and make it pop in the marketing, make it really stand out in the marketplace, like this one still does. When we have rooms available here, which isn't very often, they tend to go very quickly. But Christ, when you have problems and you've got all of the taps are different and all of the sinks are different and you're using different furniture in each room and you've got different colors and just different design elements that maybe are, all of these are custom built. So if you've got problems with it, then you just get yourself into a position where maintenance just becomes a bit of a faff. So that was a huge lesson to learn. I'm pleased that we went through that experience of doing something that was a little bit different. If you're scaling and you want to scale a large portfolio, from the start, get yourself a system. Maybe the first project, just get through it. The second one, try to systematize these things that you're buying. So whether it's same kitchens, same bathrooms, just find a design that you're happy with that's high end and just keep going with that one. Now, before we jump into the numbers, if you want to download that full case study, including the figures, the plans, the photos, and the exact breakdown, it's all in the Kent HMO Alliance through the link in the description below. And if you want to just grab it and read through it yourself, then it's there. The Alliance isn't just where we drop case studies like this, it's where HMO landlords across Kent can come together to ask questions in our discussion groups, share strategies, and build some proper momentum. We're building towards having a collective voice that we can actually use when the council make life harder for landlords, because right now we're all fragmented and that's not helping anyone. So free tools, step-by-steps, case studies, and a community of landlords and investors. The link's in the description, or stay with me now and I'll walk you through the exact numbers from this project, start to finish. So how did all this stack up? So we bought the property for £285,000. It was all cash. These are the solicitor's fees, mortgage survey fees, and everything that we paid, for a total of £301,100. Then the property we had 2 rooms at £700, 2 rooms at £725, 2 rooms at £750, and then that couple's room that I showed you went for £950, for a total of £5,300 per calendar month, or £63,600 per year. Management fees and running costs, including a 5% maintenance budget, at just under £1,500 per month, or £17,600 so for annual costs. Then our build costs were a total of around £205,000, with around £12,000 of architect's fees. We used a designer, measured survey, planning consultant, all that kind of stuff. Okay. Then the property, we used a commercial refinance. So after a 25% deduction for costs and a market yield of around 7.6, our revaluation was £630,000. Then you've got to factor in the refinance costs. So you'll have some legal costs to pay there, which are in here. The broker fee, mortgage application fee, which is one that lots of people miss, was 2%, so around £10,000 toppy. But when you're doing a project of this scale, you can really factor that in, and I'll show you the return on investment in a minute and you'll see. Valuation fee, so sending a valuer in to value the property, costs around £1,200. Mortgage interest was 4.7% and costs us £1,867 a month. The property cash flows just under £2,000 per month, so £23,511. Total cost for the project, £533,000, including everything. So purchase price, build costs, all the fees, absolutely everything, £533,000. And then at 75% loan to value on the remortgage, based on the £630,000 revaluation, we left around £60,000 in the deal. So we had only £60,000 left of our own money inside the deal when we'd finished, and a return on investment of just under 40% with a cash flow of just under £2,000. Now, if you've made it this far in the video, guys, let me know in the comments. Would you have done anything differently on this project? Would you have extended the ground floor to add an extra bedroom or a larger communal area? Or would you have gone for fewer rooms? And if you're new to the channel, that makes two of us, because so am I. I'm really new to this, so if I need to explain more, if I need to slow down or keep things tighter, just let me know. I'm making these videos for people just like you, and with all the bright lights and trying to get all of the information over to you, I might just be missing stuff or skipping over the important things, and I want this to be valuable for you. So let me know if you'd like to see what you'd like to see more of, what you'd like to see less of, or any topics you want me to cover, and I'll add it to the list. But if you're still here and you want to see what we bought next, straight after this one, click here and I'll show you exactly the project that came after this one, how it came together and everything inside. I'll see you there.